I do think that Bitcoin, I think that cycle is not done. I do think we're going to see higher prices of Bitcoin in 2026. Could be wrong on that, but that's certainly my base case. Because I think we'll see somewhat of a rotation there, somewhat of an exhaustion in the gold market, somewhat of a bid up in the Bitcoin space, especially now that a lot of those Treasury vehicle excessive valuations have been, kind of deflated. So that's not really a headwind anymore. Then I think a lot, there still are pockets of equities that are interesting to benefit from the debasement trade. While some stocks are expensive and many markets are kind of at very high levels, I continue to be somewhat bullish on emerging markets on a select basis. Ironically, think banks are not a bad place to be longer term because they've got high rates of cash and treasuries relative to total assets.
Despite weakening economic signals, markets continue to defy gravity. Stocks remain elevated. Bitcoin trades near $100,000. This resilience, financial analyst Lyn Alden argued, that stems not from monetary policy but from the enduring power of fiscal stimulus. Over the past 5 to 6 years, fiscal policy has emerged as the dominant macroeconomic force, reshaping market dynamics and confounding traditional expectations. Unlike past cycles where government spending surged only in recessions, Alden noted that today's deficits remain extraordinarily large even in periods of expansion, sustaining economic momentum and investor confidence. Expanding on this, Alden explained that fiscal interventions extend beyond spending alone. Tariffs, enacted through executive powers, function as unilateral tax measures that bypass a divided Congress, allowing the administration to alter economic conditions without legislative approval. Yet the legality of this approach faces scrutiny, as the Supreme Court is set to review former President Trump's use of emergency tariff powers after lower courts rejected them. This tug-of-war between executive action and judicial oversight underscores how deeply intertwined fiscal policy has become with the broader macroeconomic landscape. Alden emphasized that persistent fiscal deficits directly fuel nominal GDP growth, keeping it structurally elevated even amid cyclical slowdowns. While traditional indicators like PMIs suggest deceleration, the fiscal foundation continues to provide a powerful floor beneath economic activity. This, she explained, is why asset markets remain robust despite tightening conditions elsewhere. In Alden's view, as long as fiscal stimulus remains entrenched, the global economy will operate on a higher baseline where liquidity stays ample, inflation risks persist, and hard assets continue to thrive. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
I've been focusing on fiscal now for quite a while. It's kind of one of the key things that I think has in many cases blindsided a lot of macro, just because in this whole kind of 5 to 6 year period, it's played a much larger role than it normally does, especially outside of recessions in any sort of like investor's lifetime for the most part, at least in the United States and many other developed countries. And so it continues to be an environment that is just challenging for a lot of people, myself included, obviously, but being on the right side of fiscal has been helpful. Basically, if we go back kind of earlier this year, my view was that Doge would be ineffective at any sort of like macro scale cuts. But the tariffs were somewhat of a wild card because, well, I don't think they can stop the train. I don't think they can like permanently and kind of sustainably reduce fiscal spending by a huge amount. They can slow the train, and that's largely because one of the key kind of defenses against reducing the deficit is that Congress is very polarized, and emergency powers to use executive orders to do tariffs is basically a unilateral tax increase that bypasses that polarized state. Now, as you pointed out, the Supreme Court is going to weigh in on that likely in November, last I checked. So far, 2 levels of courts have kind of ruled against Trump on that. But those, I mean, I'm not a legal expert. The challenge, of course, is that those were, if you look at the makeup of those courts, they were more Democratic-leaning courts. Supreme Court's obviously more Republican-leaning. But he has put out a number of posts that kind of directly contradict his rationale for emergency use powers. He'll cite domestic issues in Brazil for why they need tariffs, or he'll cite commercial in Canada for why they need tariffs, and that just gives fodder to the other side of that law case. other than looking at some of the betting markets, I don't have a strong view on how that case is going to go. Of course, before then, we potentially have the ongoing supposed de-escalation in this recent tariff flare-up between the U.S. and China. It's still not fully clear whether that's going to go through or not. And so I think that the key reason why that's still in play is that if you look at PMIs, you would expect, for example, just looking at them in isolation, if you just say, okay, PMIs are doing this, overall economic activity is slowing to this degree, would stock market be where it is? Would gold have soared as high as it is? Would Bitcoin be 100,000? Would we have kind of had this long of an inverted yield curve without a Ember-defined recession? Basically, the fiscal component is kind of weighing on a lot of that. And I had some discussions or debates with Andy Constant over the past year, and it is true that like we're not accelerating the train right now. If anything, we're mildly decelerating what is still a very fast train. Especially in a non-recession environment, these are still very large deficits. And so you have this kind of background stimulatory component that does fluctuate, and that's why I don't just stop writing reports and go to the beach for a year, right? I'm still kind of mapping out the rate of change these things happen, the news events that happens, little booms and busts that happen along the way. So there still are opportunities, there still are uncertainties along the way, but that just kind of underneath this whole sine wave that we normally invest in, there's this higher floor. And so right now, yeah, we're more compressed than we were last year. So basically, we had, of course, the huge COVID stimulus, and we had in 2022 was kind of the contraction from all of that, as well as higher prices. 2023 and 2024 were this kind of reaccelerating period in a more mild sense than, of course, the boom. And 2025 has been this decelerating period, but from that high level. And I don't think that will just like persistently decelerate back to what we saw pre-COVID. And then, of course, the other factor is that while nominal GDP is not as explosive as was before, it still is often surprised to the upside, especially compared to a lot of what the bears were expecting. And one of the things I kind of point out with fiscal deficits is that they directly fuel nominal GDP. Of course, they have all the other offsets that can, detract from nominal GDP growth. And so when you look at, say, deficits as a percentage of GDP, or even overall federal debt as a percentage of GDP, I don't expect that to grow very rapidly because I think that both nominal deficits and then to some extent nominal GDP will be generally more elevated than average for what we're used to, say, throughout the 2010s, with the caveat that we still have this, this general like sine wave type activity along the way.
Lyn Alden's analysis highlights the deep interconnection between fiscal expansion and liquidity management in shaping today's global markets. She explained that the core issue is not duration risk but the quantity of liquidity circulating within the system. When the Federal Reserve slows or reverses its balance sheet reduction while large volumes of Treasury bills enter the market, those securities must be absorbed by investors, often commercial banks operating on a fractional reserve basis. However, as banks reach their liquidity limits, less leveraged institutions step in, creating a delicate balance. This dynamic has produced a continuous tug-of-war, the Fed attempting to withdraw liquidity, while the U.S. Treasury reintroduces it through mechanisms such as the reverse repo facility. The result, Alden noted, is a market environment where liquidity remains structurally elevated, preventing deep contractions and keeping asset prices resilient. From 2023 onward, Alden observed that rising interest expenses and demographic pressures have reignited fiscal expansion, reinforcing a more accommodative monetary backdrop. While she remains long-term bullish on gold, Alden expects capital rotation toward Bitcoin through 2026 as its cycle matures. Overall, she believes this sustained fiscal monetary synergy maintains a higher global liquidity floor and supports elevated asset valuations. Let's get back to the interview.
Right, so it's not a direct impact on duration. It is a direct impact on quantity, which is to say that if the Fed is not reducing their balance sheet or if they're outright decreasing it, and a lot of T-bills are coming to market participants have to absorb those somewhere, which means they have to not own another asset. Now, if the commercial banking system is absorbing them, that's fine because they're doing it on fractional reserve. But if they start to run into those pretty low cash levels, then even they have trouble just keep gobbling up T-bills. And so then you have kind of non-levered or less levered entities having to absorb these T-bills, which basically is almost a one-for-one not owning something else. And so when they swap reserves for T-bills, before the swap, of course, they create the reserve out of nothing. So for the bank itself, it's a neutral trade, but for the market as a whole, it is net liquidity entering the market at the base level, and it allows basically the continuation of banks buying treasuries. It allows the continuation of banks making loans without going below their either preferred or required liquidity thresholds that they have in various ways. So yeah, I think the debasement trade is still in effect. It goes through different seasons. Like I said before, so in kind of the run up to COVID, you had a tightening of the situation. Obviously, the repo spike in late 2019. That was kind of, I would say it was kind of the beginning of the debasement trade as far as I saw it. Then you had, of course, the whole COVID era hyperstimulus. Then 2022, you had a pretty big attempt to pull some of that back. So you got quantitative tightening, you got fiscally all the fiscal stuff. A lot of that evaporated. You got this kind of fiscal pullback. 2023 and thereafter, the rising interest expense started to impact the government, and the demographics continue to age. So you started to get this kind of rising fiscal situation again. Ongoing debasement trade, even though the balance sheet was no longer a component of that. You had activist treasury issuance, so we're taking money out of reverse repos, we're putting that back into the system. And so you had this kind of interplay between the Fed and the Treasury for like 3 years, where the Fed was trying to gradually take liquidity out of the system. The Treasury was kind of trying to put it back in, mainly from the reverse repo facility. That was mostly just taking like unused liquidity and sticking it back in, just kind of distributing it back out gradually. And now we're going to be entering a period where we're back into net baseline liquidity happening. Now, even during those 3 years, you still had banks levering up on treasuries. So you had deficit spending fueled by fractional reserve, which means it wasn't like one for one. It wasn't like a private sector entity had to buy a treasury instead of buying a stock. As long as banks were a pretty meaningful buyer of treasuries and doing so on fractional reserve, it wasn't that one for one replacement. So it wasn't as tight as many people thought. So we've kind of been persistently in this debasement trade, other than maybe 2022. And I think that's going to continue. Now, I think that where that shows up best fluctuates. So I think that while I'm still long-term bullish on gold, I do think it's somewhat overdone in the near term. If you would have asked me, a couple of years ago, I would have said, yeah, I could see 3,000. I didn't necessarily have 4,000 on my radar, even as a bull. As someone who was long it this whole time, I would not have guessed we'd see, well over 4,000 at one point this quickly. I do think that Bitcoin, I think that cycle is not done. I do think we're going to see higher prices of Bitcoin in 2026. Could be wrong on that, but that's certainly my base case, because I think we'll see somewhat of a rotation there. Somewhat of an exhaustion in the gold market, somewhat of a bid up in the Bitcoin space, especially now that a lot of those treasury vehicle excessive valuations have been, deflated. So that's not really a headwind anymore. Then I think a lot, there still are pockets of equities that are interesting to benefit from the debasement trade. While some stocks are expensive and many markets are kind of at very high levels, I continue to be somewhat bullish on emerging markets. On a select basis. Ironically, think banks are not a bad place to be longer term because they've got high rates of cash and treasuries relative to total assets, so they're pretty buffered from shocks or kind of losses elsewhere. The K-shaped economy makes it so that even as some of their customers suffer, other customers are doing pretty fine. They're getting paid interest on what is probably going to be an increasing base of reserves. For them. And so there are pockets, I think, to hide out here. I think the debasement trade continues, just perhaps, not as quickly as it, certainly not as quickly as it did in 2020, 2021, perhaps not as quickly as it did in, say, 2023. But I still think it's elevated. And then it has that aspect to it where it's less cyclical. It's just less of that kind of business cycle up and flow. It's that higher floor we discussed earlier. And that applies not just to economic situation, but it applies to the debasement trade itself.
The ongoing interaction between fiscal expansion and liquidity management continues to define the global economic landscape. Despite efforts to tighten financial conditions, government deficits, Treasury operations, and strategic liquidity injections have maintained a structurally elevated monetary base that supports both growth and asset prices. This persistent liquidity backdrop explains why traditional signs of slowdown have failed to trigger a deeper contraction and why inflation-sensitive assets such as Bitcoin remain resilient. As rising interest costs and demographic trends sustain fiscal spending, the world economy appears anchored to a higher baseline of liquidity and valuation. The gradual rotation from overextended assets toward emerging opportunities, particularly in digital and alternative stores of value, reflects the market's adaptation to a long-term environment of structural monetary accommodation rather than short-lived stimulus. How might the continued interaction between fiscal expansion and liquidity management influence the long-term performance of inflation-hedging assets such as Bitcoin? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.